Good afternoon, everybody, and welcome to the Fintech Nexus weekly news show. My name is Peter Renton, coming at you today from LaGuardia Airport, where I am going to be catching a plane here in a little bit. But the news show always takes priority. So here we are, joined as always by my good friend and colleague Todd Anderson. How are you doing, Todd?
I'm well, Peter. How are you?
Doing well. You're nicely settled in our studio at the New York office, I see.
Yes, that's right. And you are the traveling roadshow at the
Yes.
newly renovated LaGuardia Airport.
Yeah, I couldn't do this in the old LaGuardia. I wouldn't have wanted to. The new LaGuardia is much better.
That's for
And
sure.
joining us for the first time today, we have Alex Johnson. How are you doing, Alex?
Doing well. Thanks for having me.
Yeah, thanks for coming.
My pleasure. Yeah. So why don't you give just a little 30-second intro about yourself so everyone understands who you are.
Sure. Yeah. So I'm broadcasting from my home office in Bozeman, Montana, where it is currently negative 10 degrees outside. And
Wow.
so I was trying to stay warm. And from my full-time job, I write a newsletter called Fintech Takes, which analyzes the sort of collision of banking and fintech, and have spent about 15 plus years bumping around different parts of the financial services industry.
Okay, and it's a great newsletter you produce, a must read, I would say, for everybody in fintech.
Yes.
But let's get right into it. We have another busy news week. We're actually going to start off with Coinbase this week. Coinbase reported earnings, and I think, as expected, they were. It was bad. It was a bad earnings report. 2022, not a good year to be in crypto, particularly if you're a large exchange like Coinbase. They went from a massive profit in 2021 to a massive loss. Brian Armstrong in the earnings call said that every 2 years the sentiment flips on crypto. So don't judge us for what happened in 2022. So that's all well and good. But the one silver lining, if there is one, from the Coinbase report is that it beat expectations. So that was. So the stock didn't dive like many thought it might. But anyway, Todd, what are your thoughts on Coinbase?
Well, I thought the other silver lining was actually the rise in subscription and services for them, which to me is actually hopefully a better signal for Coinbase, because living just on trading volumes is a bit of a precarious business model, and ultimately many in the space do believe that fees will eventually come down there. So there's only so much time they can live off of trading volume and fees generated from that. But, I think crypto and there's another story we'll talk about next is in a pretty precarious position right now with how the regulators are viewing the space. And it makes companies like Coinbase, who for all that we know have been doing things above board for quite some time, and are open to regulation and being regulated and compliant, but it seems that regulators have a one-track mind right now, and that is to hit the sector hard. And so no matter the spin that Brian and the team put on it, it's still a tricky time to be in crypto and to be a platform like Coinbase.
Yeah, I mean, I think that to Todd's point, the trick with crypto is trying to figure out how you can broaden your business beyond just buying and selling and the trading of cryptocurrencies, which obviously is massively volatile and fluctuates quite a bit. And the challenge is that it's really difficult to turn something that volatile into a more sort of stable business venture, right? I mean, even the interest in something like NFTs was very speculative, right? It turns out people weren't actually buying them for the sort of art itself. They were buying them to speculate and flip them. And when the market flips, that goes away. To your point about regulation, I think the other thing that Coinbase has sort of strangely benefited from is being a little bit more closely regulated. And Brian likes to go on Twitter and argue and complain about the SEC stopping them from doing stuff, but the SEC stopped them from doing one of those earn lend products where they were going to lend out users cryptocurrency in exchange for interest. And I think they probably saved them on that one, because all of those earn products have sort of burned to the ground as a part of the sort of overall decrease in the crypto market. So I think regulation actually stopped them from making a big mistake there. I didn't see Brian like apologize to the SEC on Twitter or anything, but I think that is something that they
Right.
strangely benefited from.
Yeah, that's very true. And I mean, I think he made the point too that long term he thinks Coinbase is in a good position because they are doing things the right way, and they once the industry is regulated, then Coinbase will be in a solid position. But that parlays into our next story, which is really about the SEC, and they've been doing all sorts of different moves. And this week we read about them going after stable coins now. And this is a little bit more of a gray area because they've already taken action against Paxos. We reported on that a couple of weeks ago with the Binance stablecoin. They're not allowed them. Paxos are no longer minting any new stablecoins there. But some of the legal kind of commentary this week was that if they're going to try and call stablecoins security, that might be a tough one to win because people don't like they don't buy a stablecoin with the expectation of earning a return necessarily. It's just sort of a place to park your money, and the CFTC and the NYDFS, the New York Department of Financial Services, have both said that stablecoins are actually virtual currencies and not securities. So the SEC might be in for a tough row here. What do you think?
This one feels like overreach on the side of the government in the sense that, if they're working on a brief about the Howey test, I mean, it doesn't seem to fit the parameters there because a stable coin just by its name is not, looking to increase in value over time. I think this goes back to the FTX and the blow-ups of the summer, which is, and I think it was the lawyer, Tim Spangler, in the piece said, the regulators are within their right to look under the hood. And so maybe that's really what to read between the lines is what's going on here. But it feels like if they're really going to, take this stance on stable coins, it's a bit overdone in this sense. But it just seems like everything in crypto right now is it's getting a light shown on it, and they're going to have to go through a real tough time with regulators and potential new legislation coming from the legislative body as well.
Yeah, well, and I think, I get the impulse, right? I mean, I agree. I don't think there's really much of a case to be made that stablecoins are securities. I think it's more likely that, like NBA Top Shot and other NFTs end up getting considered securities than stablecoins, just by the nature of sort of how they're talked about and what value they provide to the end investors. But on the other hand, stablecoins from a crypto ecosystem perspective sort of play the role of like a central bank, right, within crypto in terms of providing sort of a central mechanism to transact with. And, the job of a central bank is to just be boring and just facilitate payments and not do anything exotic or interesting with the money that's trusted to them. And if you have read anything about sort of the colorful history of Tether, which is the largest stablecoin issuer, there's some not good stuff happening behind the scenes with some of these stablecoins. They're not so stable. And I think in the piece that you referenced, it actually mentioned that another sort of alternative or option for regulating stablecoins is to treat them more like banks or bank accounts. And I think that's more directionally the right way to go. I don't know if the Fed or the OCC or whomever would have an interest in wading into the stablecoin area. But I think, if you look at just like where regulation is supposed to fall, I think it probably makes more sense there. It's just the SEC has been the one that's been knocking on everybody's doors recently.
Right. It's a really good point, actually, because that's the whole thing with Tether. I mean, Tether supposedly now are doing a better job. But, for a while there, they had some pretty illiquid, backing reserves that were backing their stablecoin, and now it's supposedly a little bit better. But, and USDC, the Circle, the second largest stablecoin, they claim to have been above board the whole time. But as you point out, though, that they're really it's more of a banking type mechanism, and it's not really in the SEC's purview. But I think as Todd said, maybe they're just sort of just looking under the hood, and we'll see what happens. But anyway, let's move away from the crypto stablecoin world now, and This is one that I actually didn't notice until after this article was out. But India and Singapore have they're pretty advanced actually when it comes to real time payments. You got UPI in India, you got PayNow in Singapore, and what they're doing is these two countries are now connected, so you'll be able to do real time payments between India and Singapore. And it's obviously not a massive corridor. It's $1 billion of cross-border payments a year. But to me, what's most interesting, this is the first instance I've seen of any kind of real-time payments happening across border. And I think it's something that we should all pay attention to and be watching closely.
Yeah, to me, I think the most interesting part of this is the interoperability, because I think we've seen payment systems, even here in the U.S. crop up, Apple and Block or Square trying to keep people within their kind of circles or systems. And to me, the key to a lot of these, FedNow coming out now, the key is how do you interoperate between the various systems, because ultimately that's what unlocks the potential of all this to work together in a sense. And that's where I think this is most interesting. And the cross-border element, the cost of cross-border payments is in some ways very detrimental, especially in emerging markets. And so to make this a more efficient and lower cost way, I mean, it can only benefit markets, especially like Singapore and India, where here in the States we don't have as much tie to the cross-border payment. I mean, there's a lot of expats that send money, especially to Latin America here, but it doesn't feel as close to us here, but it's a huge market around the rest of the world.
Yeah, well, and just piggybacking on that, Todd, I mean, the fees are just insanely high, right? I think in the TechCrunch article was saying that the average is like 6.5% of the payment. And that's orders of magnitude higher than it is anywhere else. And I think it speaks to the challenges of building that interoperable system. I think the other thing that's interesting to me about this one is this is an example of governments building payments as a public utility, right? And not just doing it within their own borders, which is what India and all of these other countries have been doing, but now building sort of interoperable ones between countries. That's a huge shift, I think, in just like the sort of last 100 years of financial services history, right? I mean, we already have global interoperable payment systems, but they're called Visa and MasterCard, and they have fees, and they don't work for every use case. And I think it's really interesting that I think someone on Twitter a while ago asked, like, what's the biggest threat to Visa and MasterCard long term? It might actually be government stepping in and going, payments is really more of a human right, and it should be something that we just offer as a service to our citizens for free. Maybe we charge a little bit for business use cases to pay for the system, but like, we don't want companies making money on payments. We want to just offer a sort of core set of payments functionality that everyone has access to in order to facilitate higher levels of commerce that we want to encourage. And I think that's been the theory behind UPI in India. Brazil's doing something very interesting around this with a P2P payments app called Pix that they've recently launched. So you're seeing this in a bunch of different places. The US is, I think, very resistant to this idea because we have our own systems that we like, and we like to make money off of.
Yep, exactly.
Yeah, no, that's a good point. I feel like it's going to be that's going to be a hard or a slow change here, but it's a valid point though, that particularly when you get into like FedNow, obviously that's a government-run program. That's going to be here in a fairly short time, at least in a pilot way. And I think that's that I hadn't really thought about that though. The whole biggest threat to Visa and MasterCard was governments. That's something that I'm going to have to noodle on. Really,
at least
really
from that angle. Usually we hear like the reason why Visa and MasterCard will lose market share is because the government will force them to like lower fees. But not from this angle, which is, I think, the more interesting angle, which is, payments are essentially a right, or at least the ability to move money is a right.
Well, and to that point, right, like Brazil, Pix has actually overtaken Visa and MasterCard as like the primary payment mechanism in that
Yeah.
country, right? And it's not like the government of Brazil said, hey, Visa, you're not allowed to compete in this market. They said, go ahead and compete. We're just going to offer this system, and we're going to offer it for free or very low cost, and let sort of competition sort of drive people to the solutions that work best. And so that I think is a very big threat long term.
No, we've talked to some of the people at Visa and Mastercard in Brazil, and they're not. We have a Latin American event, and they're not overly happy with the success of PIX, as you can imagine. But anyway, let's move on. I want to talk about Green Dot. Now we're going back to old school payments, cash. So Green Dot is partnering with fintechs to help them reach those customers using cash. Now it's sort of a counterintuitive thing in some ways to partner with fintechs for processing cash, but there are a lot of fintechs who focus on the underserved, and many of the underserved are using cash. I mean, they talked about some of the like Greenwood and Payment US, Broxel. These are partners now of Green Dot, and the whole idea is to allow bill payments and those sort of things at distributed locations, or 7-Elevens or supermarkets, Walmart stores, or what have you, being able to process payments in cash, where it's still, that is still something that needs to be tackled. And I feel like there's still the underserved do the majority of their payments still in cash.
Yeah, and they in many ways they don't trust banks, and and part of the reason they don't trust banks is because they usually are hit with fees for the account, for a payment, for a transaction, whatever it might be, and the lower you are on the income scale, the more a bank costs you. And that's why I think there was that study a few years ago. I think a professor from University of Pennsylvania that worked at a check cashing place and found that it's actually lower cost. And Green Dot right here is going back to kind of what they know best, which is the unbanked or underbanked prepaid cards, and kind of figuring out how to get people using the financial system in an interesting way that doesn't involve a traditional bank. And this was, there's probably some people in government that would probably rather this go through the postal office, but that's essentially the concept here, which is, the 7-Eleven or the CVS can be a bank in a way because of some of the products that they're able to serve through there, and that's where Green Dot fits in nicely.
Yeah. Well, and I think that, there's a study that the FDIC, I think, does every couple of years on how American households bank, right? And they sort of track the number of American households that are banked versus unbanked. And the percentage that are unbanked has been plummeting, right? Over the last 10, 15 years. I think it's something like 6.5% of American households now are unbanked. And it's getting to the point, to your point, Todd, where households that are unbanked are more unbanked because of choice, right? They don't trust banks.
Yeah.
There's other reasons why they're choosing to sort of stay out of the financial services industry, but they still need options for moving money around. And cash is it's kind of the last mile problem in fintech, right? You can do all this fancy stuff, moving money around electronically, but at the end of the day, when you have to get cash and take it to a physical location, there's concerns about safety. There's concerns about sort of the amount of time it takes, out of your day, which is a suck on productivity. So there's all of these sort of knock-on effects to dealing with cash that make it really, really painful, right? We saw this in the cannabis industry before it started to get banked as well. They were just dealing with massive piles of cash, and it's hard, right? There's all these new problems that come out of it. So I think you're right that Green Dot, based on its history and its sort of expertise in this area, is well, suited to sort of help deal with this last mile problem in fintech.
Yep, for sure. Anyway, let's move on to an article in Bloomberg that came out overnight, and talking about the headline is after multi-billion-dollar fintech binge, Wall Street has a write-down hangover. So that was that's pretty much it. Basically saying a lot of these companies, a lot of these banks and other investment firms, they overpaid for fintech firms, and now they're realizing that, and valuations are being slashed, and there's basically a reckoning happening. We've seen JP Morgan, obviously, with Frank, but they overpaid for that acquisition dramatically, and they're not the only example there.
Yeah, I mean, and this is it kind of brings up the point of kind of where's the bottom in a way. It still feels like there's if you're early stage and you have a solid plan and go to market, you'll get some early stage capital. But there's a lot of capital on the sidelines right now, and I think that they're waiting for either a bottom or a signal of kind of when to restart that engine. And I think you'll have it as like a slow climb over the next probably 12 to 18 months. And I don't think you'll see the same exuberance. But I mean, this happens all the time in venture. There's they jump on the train and then all of a sudden the train is a little bit ahead of its ahead of its tracks and it comes back down to earth. I mean, this is not that dissimilar from other boom and bust cycles that we've seen in the past.
Yeah, I mean, I think for this cycle, this most recent one, I'm sort of calling it the SoftBank problem, right? Which is that
Right.
you're an early stage fintech company, you're growing, you're doing good things. Maybe you've been, in the market for a while and you're sort of patiently growing, maybe not taking too much venture capital. And then right around 2019, 2020, VC investment in fintech explodes. And it's not just specialty fintech investment firms that really know what they're doing. It's these broad firms that look across every industry and that write big checks really fast. And they come to these fintech companies and they go, hey, how would you like $100 million and to instantly go for your Series C to becoming a unicorn? And it's very difficult, I think, for those companies to say no. But I think we're seeing the outcome of those sort of artificial accelerations in these companies' timetables where they had way more money than they knew what to do with. Their only instruction with it was to grow as quickly as they can. And I feel for a lot of these companies that are sort of on the back end of this problem because they did what their investors told them to do. They grew. They didn't worry about profitability. And now the environment's changed and suddenly they can't get any more money and they're sort of having to deal with the problems that have come out of that. So it's just one of those things, to your point, Todd, that's somewhat cyclical and we're on the backside of it.
Yeah, I don't see us going back to 2021 anytime soon. Though. I mean, obviously we know that a lot of people have short-term memory, but that level of exuberance I think is unlikely to replay in the near term. But anyway, I want to move on to Stripe because this was a super interesting news story this week from The Information. They've been tracking the Stripe story really carefully. They must have some great people inside the company to be doing this. They've got a hold of Stripe's fundraising deck, and it really is interesting kind of look behind the scenes. Stripe, we know that they've hired Goldman Sachs for it's their Series I. I don't know what I don't very often see a Series I, but that's what they're going for. They apparently need $4 billion by the end of 2024 to cover a tax bill. $2.3 billion they need by the end of Q1, which is 5 weeks away. That is not a good place to be in. I'll be surprised if they can maintain that $55 billion valuation. That'll be impressive, considering it seems like they need the money.
Yeah, I mean, this goes to some of the back to 2020 and 2021, which is some of the decisions they made then. Obviously with the overhiring, which they then cut their staff, but other decisions they made, which are kind of coming back to haunt them a little bit. But you do see that, the fundamentals of who Stripe is still points to a very good business long term. But, I think the one area where they haven't necessarily excelled is moving beyond similar issues as Coinbase, which is moving beyond their core payments business and that payments volume business. And they haven't had this like outlier additional product yet. And so I'm sure that eventually they'll get there, but it doesn't seem like they've hit on some of the ideas they've had. And they'll probably raise money from investors. Will it get to 55 billion or a little bit less? But overall, I still think Stripe is a darling of fintech, as at least as close as you can get to one these days.
Yeah, I mean, it's kind of like Apple pre-iPod, right? Where you're sort of like waiting for their next hit or for them to figure something else out beyond the sort of core franchise. And I think you're right. I mean, I think it's still a strong business. The problem is the valuation, right? I mean, like having to raise $4 billion to cover a tax bill associated with equity that's coming due. There's a line in that information article that said the cash needs of Stripe right now are roughly double the amount of venture capital that Stripe has raised in its history. Like, that's wild. That is wild. That's the craziest thing I've ever heard in my entire life. And I think it just, again, is an indication of strong business, generally well managed. I think the Collisons are universally beloved as like really great founders and very sort of thoughtful people, but that just got away from them, and now they're having to deal with that problem.
Well, like they always expected.
Sorry, Peter. I was going to say, you go back to the story last week where it said they burned through 500 million last year. It's like that, some of the numbers still feel like they don't compute because they cut their staff, but their staff doesn't equal 500 million. The staff that
and the thing is, what I think they expected to do an IPO like a year or two ago.
That's right.
And they couldn't. The market seized up, and they decided they didn't want to go do that. And now they're realizing they're in a bind, and it's going to be it's like a soap opera. It's going to be so interesting to see how this all plays out, and we'll be following, and we'll be reporting here as it happens. Anyway, on to our good friend Ron Shevlin's piece this week, talking about banks investing technology dollars. He talked about 5 different categories, the top 5: conversational AI, digital banking, CRM, real-time payments, and APIs. But the thing that was most interesting in the article is like they survey what banks think they spend, and then they survey them a year later saying what they actually spend. And I think it's always less, it seems, or it's always what they actually implement is not what they want to do. So, take it with a grain of salt as far as these 5 things, but it was interesting nonetheless.
I still think conversational AI, if a bank gets that right to the point that they, the self-service jumps a significant amount of what a customer does at a bank, I think it can unlock a lot for the bank in just taking away so much of the call center costs and others that, so many people that don't want to deal with a chat bot that it's like constantly will ask them the same question 20 times. And if they could figure that out, I think it can unlock a lot of potential for banks. And ultimately, I think it gets there. How long? I don't know. I mean, conversational AI is still fairly in its early innings.
Yeah, no, I mean, I love the research that goes into this. Ron's my old boss when I worked at Cornerstone, so I'm a fan. The report that a lot of this is based on is this annual survey called What's Going On in Banking, where they ask bankers, what are your priorities? What are you spending money on? And the takeaway I always have from it is, like, what are your delusions about what you're going to do and what's important and like what you're going to accomplish? It's like a report of banks, like, most sort of persistent delusions. And you see a lot of the same technology categories at the top of the list all the time, right? Where it's like, this is the year we're going to get, digital banking for commercial lending all up and running. We're going to digitize that whole process. And if you look at the history of it, it's like, they said that last year, they said that the year before, they said that the year before that. So it's kind of that, like, definition of insanity is doing the same thing over and over and expecting different results.
Right. Okay. Well, we're going to close with this interesting piece about JP Morgan this week and ChatGPT. And obviously, ChatGPT had no role in the creation of this news show, but JP Morgan are going to ban it. They're banning the use of ChatGPT, which I thought was a really interesting take. They're not a an educational institution, but they're a bank. And I'd love to quick thoughts on that before we close.
I don't know. It feels like some of the banks are just, would ban this because it's so new and they don't really know just yet. And so it's like, all right, let's keep this at an arm's length till we know a bit more.
Yeah, I really compelling, but the problem is it's probabilistic. It's trying to guess what you want to hear. It's not trying to give you an actual right answer. And so that's just not a real good fit with banking. And I can understand the brass at JP Morgan being nervous about that technology being unleashed inside their walls.
Peter, you're on mute.
Yep, sorry about that. I had some noisy announcement going across here. So anyway, but I think we'll have to leave it there. Alex, Great having you on the show. Thank you so much for your insights, Todd. Thank you as always.
Thanks, Alex.
Before we go,
Thank you.
though, just a quick plug for Fintech Nexus USA, our big event happening May 10th and 11th. Go to fintechnexus.com and get your ticket now. It's going to be huge. Thanks, everybody. We will see you next week. We'll be back 5 p.m. Eastern Time. Todd and I will be back on again with another special guest. Thanks, everybody.
Thank you.